Hello and welcome to Module 3 of the FX series. This is the final module in FX, and this is also the final topic in this module. And now we're going to be looking at cross-border asset diversification. Right, so what is diversification? I think we've all heard the expression, don't put your eggs all in one basket. So diversification is exactly that, not putting all your eggs in one basket, and basically spreading risk. So it's about spreading risk. One way to spread risk is to spread it across asset classes. So an asset class would be money markets, it would be FX, equities, commodities. So basically not investing in one particular type of asset class, but spreading it across. And then another thing to consider would be cross-border diversification. So, if you wanted to diversify across asset classes, you could do that within South Africa. So you could invest in South African money markets, South African equities, South African commodities. But cross-border is then when you look at asset classes outside of South Africa. And that's when you spread your risk not only across asset classes, but also across borders. So why would you consider cross-border diversification? Let's say, for example, you wanted to invest and you had a 4-year investment horizon and you were investing 10,000 rands. And let's say your investment grew at 5%, and let's assume that inflation was also 5%. So which means that in 4 years' time, you would have beaten inflation, right? And we know that inflation basically erodes your spending power. So in year 1, when you invested, you had 10,000, and in year 4, at the end of your investment period, you'd have 12,155. And if we assume that you've covered yourself for inflation, it means that what you could buy with 10,000 in year 1, you could buy the same with the 12,155 in 4 years' time. So then you would have protected yourself against the erosion of your spending power, right? So that's all good and well. But what if you wanted to buy goods online, right? Let's have a look at dollar rand. So in 2010, there was a point where dollar rand was trading at 760. And in 2014, we've seen the dollar rand trade at 1104. So that's a 4-year horizon. And if we take the same example with the 10,000 rand in year 1, so year 1 now, we're looking back in time, year 1 would be 2010. At an exchange rate of 760, your 10,000 rands would buy you 1,315 US dollars. And then if you had to fast forward to 2014, where we've seen the rand trading at 1104, and we take 1104 as a price, even if you covered yourself for inflation by investing at 5%, and you had 12,155, if you had to translate that 12,155 rands into dollars, you'd actually end up with $1,066. So just from the effect of currency fluctuations over that same period, though you've covered yourself for inflation in the local market, what you could buy online, in 2010, you probably couldn't buy the same, because not only are you looking at inflation now, but you're also looking at the fact that the currency has eroded your spending power even further. And that's one of the reasons why you'd want to consider cross-border diversification, because it takes your risk mitigation or risk management to another level. So you're not only looking in local terms, but you're also protecting yourself against an erosion of your spending power on a global platform. And that's all we have for this topic. Once again, I'd like to encourage you, when you have a moment, to download the training manual from the website with more information and also worked examples that you can go through at your own pace and in greater detail. Thank you very much.